My name is Chris Thomas, joined by Micah Potashnik, our firm's 40W advisors. Thanks for joining us this month. As you may know, every month we take on a new financial topic, 30-minute kind of crash course, educate you on things that we know are on people's mind. This month, we're talking about year-end financial planning, things you need to do before the end of the year. Believe it or not, as we were saying, it's, Labor Day is right around the corner. If you have kids, you're going back to school, then, maybe our brains are shifting, preparing for that colder weather and getting ready for the holidays. So we wanted to do this, and we've moved this back. We used to do this September, October. We moved it back to August because we want to give you time to digest and execute on anything we might talk about today. So before we get out, everybody's joined in listen-only mode. Apparently now we're also, you can hear us now. So if you do have questions, please use the questions box, which some of you are familiar with now, because that's how I found out we could not hear us. And also from a kind of administrative standpoint, if anything we do talk about today is for information, educational purposes only, shouldn't be taken as personal financial advice. So with that out of the way, feel free to reach out to us if you have questions and you want to dive deeper on this. Feel free, reach out to us, set up a time, talk one-on-one, where you can ask more questions more specific to your situation. You can see a web email address, website, phone numbers are here. Here's what we're gonna do, Micah. We're gonna talk about here's our laundry list of topics we're gonna talk about today. We're gonna talk about 401k contributions, HSA contributions, flexible spending accounts, all things that are part of your employee benefit package that you may or may not be using. Talk about 529 accounts, putting money in, taking money out, if 529 education savings accounts are something that are applicable to you. Talk about required minimum distributions. And then what we're going to switch into is the last kind of 4 items on our agenda are more strategic things that may be opportunities and may be applicable to you. And we're going to talk about those. And Roth conversions, harvesting capital gains, losses in taxable accounts outside of your retirement investment accounts. And then we're going to talk about charitable contributions and then estate gifts or estate planning. So Mike is going to kick things off talking about the employee benefits and things you might need to do by the end of the year.
Yes. So some of you might be making, 401k contributions, taking a little bit from each monthly or biweekly paycheck and putting that into your employer-sponsored plan. Again, if you're contributing directly to a regular 401k, the contributions that you are putting into those plans are tax deductible. And there's limits on how much you as an employee can contribute in a calendar year. So for 2025, if you are under the age of 50, the maximum amount that you're able to contribute is $23,500. If you're in your 50s, between 50 and 59, or over 64, you're eligible for a catch-up contribution. That catch-up contribution is $7,500 in 2025. So you'll see that's why the annual employee limit increases to $31,000 in total for the year. And recently there's been this enhanced catch-up where if you're between ages 60 and 63, you can contribute an extra $3,750 on top of the other catch-up limits. So that can get you to about $34,750. So if you are currently making contributions at any point in time, you can go in and increase those contributions, whether it's if you have a goal in mind, whether it's just to increase by 50 to 100 extra dollars per paycheck, whether it's to work on getting closer to that limit. If you'd like to maximize the contributions, you're able to go in and make those changes. One of our handouts includes a contribution worksheet that you can utilize to kind of see the math behind that. But again, those contribution limits need to get in by 12/31 to count for the 2025 tax year.
Very good. And then
similar with HSAs, HSAs are health savings accounts. Again, HSAs are accounts that contributions that go in, if they're ultimately utilized for medical purposes, you get both a tax deduction when you put the money in, the investments grow tax-free, and then those distributions when you take the money out, you don't pay taxes either. So that's why you'll see that they're called these triple tax-free accounts. If you have money you want to set aside for future eligible medical expenses, They're great tools to utilize because of the tax advantages. Again, similar to 401ks, there are contribution limits depending on whether you're an individual. If you have family coverage, you can see those contribution limits differ as well as based on your age. Again, if you're under 50, those will max out at either 4,300 or 8,550, depending on whether you're an individual or family coverage, and you get an additional $1,000 catch up if you're over the age of 50. So again, those are health savings accounts as well.
Yeah, and I just pulled it up on the screen here. This is available as a handout to you. So if you go from the media control panel, you go to the handouts, you'll see a number of things on there. We'll reference some of them throughout the conversation today. But one of the things is we put together this, this basically just a spreadsheet where you can go and you can calculate how much more if you want to increase your contributions between now and the end of the year. We've gone and created this spreadsheet where you can calculate how much you would need to increase your paycheck deferrals in order to hit your savings goal. So it'll ask you, the only thing you'll really need to have in front of you for that is you'll want to dig up your last pay stub so that you can enter some of the information that is required. So look for that in your handouts, and again, let us know if you have any questions. Oh, there it is. Just to wrap up on the employer benefits that are available to you, the other thing you may have is you may have flexible spending accounts or dependent care reimbursement accounts. If you were saving to a flexible spending account throughout the year, just a reminder, or if you were saving to either of these throughout the year, just a reminder that you have to incur the expenses by 12/31. So for flexible spending accounts, if you needed to have, I think acupuncture is like an example of something like that, chiropractor, things like that that are FSA eligible expenses. You need to incur those expenses by 12/31. Same thing with dependent care reimbursement accounts for any kids programs, preschool where you're paying a tuition, camps, things like that the kids might have been involved in. You need to incur those expenses by 12/31. Typically, your plan will allow you to file a claim for reimbursement all the way to March 31st of next year. But again, the expenses, the actual transactions have to happen this year. To get kind of refreshed on what are eligible expenses for each of these, you can go to whoever your FSA or DCRA provider is. And then you can also look at the IRS publications. We've attached the IRS publications as a handout as well, and it lists all the eligible expenses. Again, one of the things, sometimes for some of the FSA eligible expenses, it's hard to get an appointment right away. So that's another reason why we're doing this sooner rather than later, so that if you do need to make some appointments, you can call and try to get those in before the end of the year. Because there's a lot of other people in that same boat trying to make those appointments by the end of the year for the very same reasons. So shifting gears away from the employer side of things, employer programs. Now we'll talk about 529 college savings plans. So if you have 529 college savings plans for a dependent, for a loved one, if you're in the stage of making contributions, you're in the savings stage, just a reminder, you can contribute as much as you want. But if you live in a state that does give a deduction for contributions to a 529 plan, then you're going to want to make sure that you make the contributions by 12/31 if you want to claim the deduction for 2025. So that's the big thing on the contribution side of the equation. If you're currently, taking withdrawals from 529 plans to pay for education expenses, just a reminder that for any expense incurred in 2025, you'll want to take that distribution in the same calendar year. So you'll want to do it by 12/31. It's not allowed. You can't take distributions in January 15th, 2026 for a tuition bill that was paid in December 2025. So that's a really important thing to remember and to be aware of as we head in to the end of the year. going to go ahead and we got some questions here. One is won't the bill until later. So the expenses need to be, this is for the expenses need to just be dated in 2025. But worried they won't send the bill until later. Yeah, it depends on when it's invoiced and when it's billed. So the expenses, ideally it's very clean if the expenses are billed and paid in the same year the services were provided. But if it bridges into January, I'm talking about now for FSA accounts, DCRA accounts, you'll want to get those. It's based on when it's invoiced to you. That was the question I had there. There's a question on the 401k limits. If my contributions are near the 34K limit for 401k, are the contributions by the company included in this limit? No. When we were talking about the 401k limits before, we were simply referring to your employee contributions. Only your employee contributions are subject to those limits we talked about before. The employer matching contributions or whatever contributions your employer are making are not counted towards that limit. So good questions, keep them coming. We're going to pivot now to Micah's going to talk about required minimum distributions.
Yeah. So required minimum distributions. Again, if you are over the age of 73 and have an IRA account, these are pre-tax IRAs. Roth IRAs do not have required minimum distributions. You have to start taking a little bit each year. Government pretty much said, we've given you all these tax advantages during your, as the account's grown, you got the tax-free contributions, the account's grown tax-free. Now, once you reach that age of 73, you have to start taking annual distributions. Those have to be taken by 12/31, unless you are age 73 this year. For your very first contribution, you actually have until April 2026 to take your first RMD. But in that case, if you were to do that, you actually will have 2 required minimum distributions in 2026. So that could theoretically affect tax brackets and things like that. So those are for general like IRA accounts. Inherited IRA accounts, if you've inherited an IRA from a family member, there's different rules regarding those accounts. Some of it will depend on when you inherited the IRA. Post 2019, there's some tax legislation passed that sort of changed how RMDs worked and what requirements were. And so that's a huge factor in the frequency of your RMDs. If you've inherited an IRA post 2020 and the decedent was of RMD age, you'll start having those RMDs each year. And then if you've inherited an IRA post 2020, not only that, is that account will have to be distributed in full within 10 years. So if you've inherited an IRA recently, the tax planning behind it becomes very, very important because not only might you be subject to RMDs, there's also a limitation on when you need to take the funds by. So that can certainly affect your tax brackets, distributions, and things like that. There are certain exceptions depending on your age, if you're chronically ill, depending on the age gap between you as the beneficiary versus the decedent. So there can be some rules and regulations behind that, but generally speaking, that's how RMDs work regarding both IRAs and inherited IRAs. There's also calculators online that you can utilize to find RMDs, but most often your financial institution will make for regular IRAs that easily available. The inherited side, generally speaking, those are not readily available, so you'll need to utilize a calculator or talk to a financial advisor to help do those calculations for you. Chris, anything to add to anything relating to RMDs here?
No, I think the big thing is the new rules that happen to IRAs inherited by non-spouses after 2019. So, yeah. And those rules really weren't clarified until earlier this year, and that's why you're now required to potentially take a minimum distribution every year from your IRA.
Right. The last couple of years, to Chris's point, if you've inherited an IRA, because the IRS is still figuring out the rules, there was no requirement. So if you had an inherited IRA last year and you're like, oh, I didn't take one, was I required to? The answer is no. So you're good there.
Yep. So now we're going to switch gears into things that everything we just talked about things that are just laws that require have 12/31 deadlines. Now we're going to talk about some different strategies that you might want to consider for yourself, depending on your situation. We're going to start with something that a lot of people have a lot of questions about. It's a strategy, I guess, that gets pretty highly kind of publicized, and whether or not it makes sense depends on your specific situation. One of the things that's helpful to know when you're doing financial planning and tax planning for end of the year is it can be really helpful just to know where you stand from a tax perspective. A lot of people don't know. What I'm showing on the screen is just it's an output from something that we use that just shows where this hypothetical person falls in the tax brackets. You can see tax brackets range from 10% to 37%. These numbers, this is last year's numbers, these have changed slightly. But what's important to know a lot of times at the end of the year planning is, am I in a different tax bracket this year? Maybe it's higher or lower. Maybe it's higher because there was an influx of income this year, or maybe it's lower because my income wasn't as high this year, or maybe you or a spouse were out of work for a period of time during the year, which just caused your income to be lower, therefore your tax bracket's lower. It's helpful to know kind of where you fit in there so you can decide on whether you want to accelerate income into this year when you're in a lower bracket, or whether you want to defer income into a later year when you might be in a lower bracket. So that's just kind of conceptually some things to think about is, know kind of where you land from a tax perspective or where you're projected to land. And then that flows through to a lot of different, as you can see on the right here, there's a lot of different things in the tax code that are phased out once you hit a certain income level. So just kind of talking higher level here, Roth conversions. What a Roth conversion is it's when you convert money from a pre-tax account, like your pre-tax IRA or your pre-tax 401k account, and you convert it over to a Roth account. Now, Roth accounts grow tax-free, meaning once the money's in a Roth account, that money can grow. The investments, you can, and in the future, when you take money out, you won't have to pay any taxes on the withdrawals. But when you do a conversion from a pre-tax account to a Roth account, you have to pay tax on any amount that you convert over. So if you convert, $20,000 from your pre-tax account to your Roth account, you're going to get a 1099 for $20,000 worth of income. So that's going to show up as additional income to you in that year that you did the conversion. So that's why it's really important to know, how is that $20,000 going to be taxed? How is it going to affect your tax bracket? So the important thing to know about the Roth conversion is it has to happen before December 31st. So a lot of times that's like, oh, that's unfortunate. I don't know what my tax situation is until April when I engage my accountant. Well, this is one of the things that does require a little bit more foresight and a little more thought before the end of the year. So that's a high level what Roth conversion is, some things to think about when you're considering whether it makes sense to you. There's a checklist that's available to you in the handouts. That's kind of a flow chart that will help walk through some considerations for you when you're trying to decide if or looking at a Roth conversion in the context of your personal situation. So refer to that in the handouts, and you can just get a little bit of a guide for yourself. Again, also something that if you want to reach out to us, we can talk through it in a little more detail with you as well. Micah, you want to talk about tax loss harvesting and what it is?
Yeah, absolutely. So if you have a non-IRA account, so again, remember in an IRA account, all the gains and or losses that occur in your account, you don't pay any taxes on those gains. There's no sort of tax strategies within the IRAs as you have money in the account. So this only applies to your non-IRA, what are called taxable accounts, maybe your general brokerage account. Throughout the year, if you sell a stock or a mutual fund or ETF at a gain, those gains are subject to taxes, and depending on whether it's a short-term or long-term gain, affects the tax rate of those gains. But the way paying taxes on gains work is you look at all the gains and all the losses you've occurred throughout the year, and those sort of net out, and whatever the net amount is what your potential tax liability is. Well, the IRS has set a rule that if your losses are greater than the gains you've taken, up to the net of those, 3,000 of those losses actually can be used as a tax deduction, which will lower your taxable income. So there are strategies called tax loss harvesting, where as the end of the year approaches, if you look at some of the losers in your account and potentially sell some of those losers, whether that's an individual stock, a mutual fund, an ETF, and potentially take that loss, and that way you have some losses that can be utilized, especially if you're in a higher income tax bracket, to lower your taxable income.
It doesn't just apply to investments either. It could be a real estate property.
Correct.
If you sold a real estate property at a gain or a loss, that is a capital gain or loss that you can then use. If it's a capital gain, you can use losses from your investment portfolio. If you have losses in there, you can use losses to help mitigate the gain that you saw on the real estate side too. So it applies to any asset, not just investments.
Right, really good point. So, there's a tax strategy you can utilize. Do be careful if you do sell like something at a loss. Let's say you sell, an Apple stock you own at a little bit of a loss. You can't sell it and then buy it back the next day. Those losses are what's called like a wash sale rule. So just be careful with some of the rules if you're selling something and immediately buying it back. Something to keep in mind from a tax strategy standpoint. The other thing to keep in mind as well is sometimes if you own mutual funds or even ETFs, most often mutual funds in a taxable account, sometimes the gains that have occurred within the account will get distributed to you sometime towards the end of the year. It's called a capital gains distribution, and that's treated as a tax event to you. So if you own a mutual fund, a lot of times the mutual fund companies make this public a few weeks or a few months leading up to these distributions. Just be aware that you might be receiving a tax bill as a result of those capital gains distributions. And that also can factor in sort of the loss side of the ledger, how much losses can you take, things like that. And then my last point, and Chris, I'll let you add in anything as well here, is if you were to take losses greater than $3,000, it's not a use it or lose it type situation. Those losses can carry forward to future years. So for example, you took a $5,000 net loss this year, you can only use $3,000 of that. That net $2,000 that you didn't use gets carried over, it can be used to offset future gains in years to come. Chris, anything to add to anything related to the taxable accounts?
No, I think, I think you summed it up. We did get a question, and I'll just repeat it. Someone asked if there's any income restrictions on doing a Roth conversion. The answer is no. Anyone can do a Roth conversion. It's not like making contributions to a Roth IRA where there are linked income restrictions. A conversion from pre-tax IRA to Roth IRA, no income restrictions, anyone can do it. So wrapping up with two things that we'll wrap up with charitable deductions. Like if you charitable deductions, if you itemize your deductions, and this is another, when you file your taxes, you either take the standard deduction or you itemize your deductions. Itemized deductions include things like your mortgage interest, your state and local income taxes, which we'll talk about in a second, and then any charitable contributions. If you add up those itemized deductions and they exceed what the government gives you in the form of a standard deduction, then you will take whichever one's higher. So your itemized deductions are higher than the standard deduction, then you get to itemize, then you claim your itemized deductions. One of the problems that's happened, not a problem, but one of the things that happened with taxes up until the most recent tax changes is that they capped your state and local taxes at $10,000. So anything you might have paid in state income taxes, if you live in a state that has income taxes, anything you might have paid in property taxes, it was all capped at $10,000. So what you were really left with is you were left with, up to $10,000 of state and local, and then any mortgage interest that you had. A married couple filing jointly could have a standard deduction limit of, I think it was $26,000 most recently, Micah, something like that, 25.
A little bit higher, but yeah, but a little bit higher, but yeah, yes, close to.
So it was very hard for a majority of people to get above that, to itemize and get above that standard deduction limit, because the standard deductions were so high and you were limited on your state and local income taxes. Well, the most recent tax bill changed the way it's going to now raise that $10,000 cap to $40,000 for state and local taxes. Therefore, a lot of people will probably start itemizing more, which just means those charitable deductions are going to be tax deductible, could be tax deductible for you again. So if you were in a situation where you weren't itemizing, you were doing the standard deduction, you actually were not getting a deduction for any charitable contributions that you made. So the fact that we're going to see these rules change means that most people are going to be able to deduct charitable contributions. They're more likely to be able to deduct charitable contributions. One of the things particular for this year, 2025, is doing deductions now could be more advantageous this year than next year, because next year there's some restrictions that are coming in that are going to kind of limit charitable deductions a little bit. I'm going to leave it there. It's kind of a broad, and I'm sorry I kind of teased that out a little bit, but I just don't want to go too much into the weeds on that, except to say that if you're making charitable deductions, it's important to consider, is this a year where you're in a higher tax bracket where you want to make those deductions or make those charitable contributions? And are you, if you're looking for a tax benefit from those charitable deductions, are you going to be itemizing where you do get a benefit, or are you going to be using the standard deduction? If you want to lump your benefits together and you want to put do a bunch of charitable contributions this year, because maybe you're in a higher tax bracket this year, you can use something called a donor advised fund. A donor advised fund is a place where you can contribute money, or you can contribute stock into a donor advised fund. You get a tax deduction in the year that you donated into this fund, and then that fund sits there. And think of it like an account. It's just an account. It sits there, and you can withdraw and give to charities out of that account whenever you would like throughout your life. So you can do a lump sum contribution, kind of have a larger kind of charitable account just sitting there, and then you can distribute from that to whoever you would like, as long as it's a qualified charity, whenever you would like, in whatever amounts you would like throughout the rest of your life. So donor advised funds can be a great strategy for that. Finally, on charitable front, if you are over age 70 or over, you can give directly from your IRAs to a charity. And that can be a great way to, you don't pay any tax on that. It's not even a deduction. You just don't have to report the withdrawal from your IRA account. And if you're subject to RMDs, if you're having to take RMDs, then any deductions you take, any qualified distributions, any charitable distributions you take count towards your required minimum distributions. So it's a way to satisfy your required minimum distributions without having to pay any tax on it. Majority of people here are not in a situation where they're taking required minimum distributions, so I won't go into any more detail there.
And just one thing to throw in there too, Chris, but those are qualified charitable distribution eligible, regardless of whether you file standard or itemized, you get that. So where most charitable contributions, you have to be itemized. When it comes to QCDs, as we call them, you can do it regardless you file standard or itemized.
Right. Yep. Great point. And then the other thing from a estate planning perspective, some people, if you want to give a gift to somebody other than a spouse, those gifts are reportable if they're over $19,000 per person. So you are allowed every year to gift $19,000 to somebody without having to report it as a gift or file a gift tax return. So if you're looking at 19,000 is a magic number for this year for annual gift exclusions. And then The other thing too is if you're related to that is a lot of times we're trying to, if you have a large estate and you're subject to estate taxes, it really doesn't affect a lot of people anymore. But if your estate, if your total net worth is over 15 million as a single individual, over 30 million, or projected to be over these amounts, then you may want to do some gifting between now and the end of the year as part of an overall estate plan, estate strategy to reduce your estate taxes. And again, gifts just need to be done by 12/31 in order to count for that calendar year. Anything else to add to anything, Micah? I don't see any more questions coming in.
Yeah, Marilyn, I think that the gift of 19,000 is per person. So if you and a spouse, are gifting to a child or grandchild, you each can do 19,000 for a total of 38,000 in that situation.
Right. So we talked about a lot today. If you want to, this QR code, we use QR codes because you can just hold your phone up to the screen, and what that'll do, that'll take you to a calendar where you can schedule a meeting. You can schedule a meeting with us if you want to dig deeper in. We talked about a lot of stuff today that, it can get, some of it's very specific to individual circumstances. So if you want to talk through them a little bit more, a little more specifically to you, scan there, send us an email, and we can schedule a time, 30-minute time block, just talk about whatever it is that's on your mind. Talk to myself or with Micah on that. Coming up next month, we're going to talk about open enrollment. So we're going to talk more about employee benefits. We'll talk more about those FSAs and HSAs and DCRAs and all of those things that you're going to have to make decisions on. Potentially, a lot of October and November tend to be popular years or popular months when open enrollment is for your employee benefits. We want to just talk to you about those employee benefits and how to think about them in the context of your bigger financial picture, how they might help you from a wealth accumulation or wealth protection or tax planning strategies. October, we're going to come back with a quarterly market update like we do at the end of every quarter. We're going to talk a little what's happening in markets and also just provide some broad investment education. And then in November, our topic is going to be estate planning. And that's where we're going to just talk about wills, trust, and all the things you might want to consider getting in place for for your overall estate plan. So if there's not any more questions, we'll go ahead and end it here. Thank you for hanging with us. I know we're about 10 minutes over time. I apologize for the confusion at the outset. So have a great rest of your day and enjoy your Labor Day.